After years of uncertainty, companies are again actively seeking to grow through mergers and acquisitions. Ernst & Young's 2015 Global Corporate Divestment Study looks at how companies are driving their strategies and accelerating growth. Today I'm joined by Paul Hammes, Global Divestiture Advisory Services Leader for Transaction Advisory Services at EY. Good to see you, Paul.
Good to see you too, Rhonda. Thank you for having me.
You know, it's such an interesting but basic question. Why is it difficult for companies to make decisions about what to do with their business in terms of investing, fixing, or potentially selling it?
Our study, which surveyed over 800 C-suite executives across a wide swath of sectors globally, 74% of our respondents came back and said they're using divestments to fund growth. 74%.
Wow.
66% of them came back and said after they completed their divestment, the remaining business experienced an increase in the valuation multiple, 66%. 45% came back and said shareholder activism drove or played a factor with our divestment. And one more percent, 54% came back and said strategic sellers will increase over the next year. So if you think about the study and you think about the market, it's very relevant to what's going on in the deal market today, extremely, extremely relevant. And I think when you step back, the prevalence of data today makes making decisions difficult. Because if you don't have good data, the decisions that you base the data upon, right, they're going to be absolutely flawed. And there is such a prevalence of available data today, things that are publicly available. It is extremely important to be prepared to thwart off that shareholder activist or have your explanation ready for that shareholder activist and to actually cut through the data. And if you think about what happened in the 90s and 2000s and mid-2000s, companies grew by acquisition. When they did that, they had economies of scale from taking back office functions, whether it was supply chain, IT, finance, putting them together. When you're trying to make a decision and manage that portfolio, you need to pull all of that apart. You need to look at the working capital impact, the balance sheet impact, the earnings impact, and that's very, very difficult to do, and it takes time.
The report also suggests that corporate executives can learn some lessons from private equity firms. Now, this actually makes sense because the buyout shops are often the buyers of divested assets. But what value creation lessons can those corporates learn from PE?
Yeah, it's a great question. And you know what? I'm going to define something before I answer that question because in our study we talk about high performers. And a high performer is somebody that experiences an increase in their valuation multiple post-close, so something we talked about a couple minutes ago, exceeds their timing and exceeds their price. Only 19% of our respondents in the survey qualified as a high performer, which tells us there's a lot of room out there for improvement and there's a lot of room to create value. Absolutely. So if you think about private equity, your point is exactly right. Private equity is in the business of buying and selling companies. They do this every day. It would be very rare for a private equity fund to not close on an acquisition without having some type of idea of what their exit strategy is. And there are a couple of things they do on a pretty regular basis. Number one, if they're going to carve something out of an existing portfolio company, they start treating that carve-out organization as though it's a standalone entity. Move those people, move those assets, move those operations, those liabilities, move them as though they're standalone. It's going to give a buyer a great feeling of comfort that you've thought through the value creation, you have that roadmap, and you know what it's going to take to separate that business, and you've done it. Absolutely huge. Number two, think about enhancing revenue. Right? It sounds very basic, but think about enhancing quality revenue, bringing new products to market or getting in new markets. And what you're starting to see more is people entering into a joint venture arrangement, a JV. It's a great way to get access to new products, new markets, et cetera, without all the capital and all the investment. Now, certainly you've got to design a mechanism where that JV's got the ability to transfer to a new buyer, but we're seeing that much more than we ever have in the past, which is absolutely huge. The third I would say is think about extracting working capital. Only 35% of our respondents in the survey did so, which tells us there's a lot of room to do a lot more.
The theme of the report is the tension between the desire to get a deal done quickly and, of course, the need to get the highest price. What are the main factors executives should consider when they're trying to get a good deal done fast?
We saw a paradigm shift in the study this year, 50-50 in terms of trade-off and speed versus value, which is something we have never seen in the past. Absolutely have never seen that in the past. And it is extremely important, number one, to be prepared. And it's a misnomer to think that to do something fast, you don't need to go through the preparation, right? The business in question that needs to be sold still needs to be separated, number one, and it still needs to be integrated with the buyer, number two. So it's extremely important to focus on preparation to make sure the deal gets done at all, right? You don't want to put the deal itself at risk. So I think there are a couple of things to think about. Number one, you really need to define the perimeter of the business for sale. There are many times on the buy side where we'll read a confidential information memorandum and it's not clear what somebody's selling. Right? Yeah, absolutely, right? It should be lesson number one. And it's extremely important to do that. It's absolutely critical. And because you want to keep competitive tension, you want to keep multiple buyers in the process for as long as you can. Well, to do that, you really need to tailor that perimeter to different buyers. So that's extremely important. Number two, you really need to step back and say, am I providing things that are realistic, supportable, and factual? We see many deals fall apart, simply not get done at all, because somebody hasn't taken the time to do that. And it sounds trite, but sometimes people focus so much on speed, not realizing that compromised data absolutely can crater your deal. Absolutely huge. The other thing I think is very important is taking a value story and tailoring it to a buyer. 59% of the respondents in our survey actually basically created a value creation roadmap, a value story. 37% of them came back and said, most important thing that they did.
Well, fascinating study. Paul, thank you so much for your time.
Thank you, Rhonda. My pleasure being here.